Good morning. This is your boy Marcus Norman from Gentleman Style Podcast coming to you live and direct. This is another podcast for my listening audience and to support and uplift our men. Um, Today we're going to be talking about a unique topic, and I put out a feeler earlier this week, and I got a ton of requests for more financial updates and more financial tools. And so I want to make sure that I'm serving my audience. I want to make sure I'm serving my audience in the best way possible and making sure I'm always giving you quality content and giving you what you're looking for and giving you what you're seeking. Even if I don't know the topic myself, I can always get someone who does. So I'm always looking to grow, always looking to serve. And so leave your comments down in the chat block in the comment section or send me an email at marcusnorman737 at gmail.com for updates. And I will get back to you. I reply to those myself. So jumping right into it, these are the different types of assets that make you money. And these are important because they're the unique type of assets of the successful people have always focused on to produce a revenue stream and another source of income. So the first thing we're going to touch on is stocks. If do you know that if you invested $220 in 1980 in Apple, that money today would be worth $180,000? Jumping in stocks ownership gives you partial ownership of a company, a fractional ownership of a company. And typically, these stocks, you can buy stocks in almost practically any industry, anything that you want to do. And the two main ways that stocks increase in value is they increase in value, meaning that if you buy Apple stock at 20 cents a $20 a share, and that stock value or that stock price per share goes up to $30 in value, then each share of ownership that you have has now increased in value. And if you decided to sell at that point in time, you would have made a profit. You would have made capital gains on your money, and you would have made a significant portion. And so that's one way. The other option that a lot of people forget about or don't really think about when coming in stock investing is dividends. There are companies out there, REITs for example, guarantee, almost guarantee high. Nothing is guaranteed in the stock market. That's why I paused back there. But dividend payments. So there are companies out there who have paid guaranteed dividends for the past 30 years. And that's a significant piece. AT&T, Coca-Cola. These are companies that have paid dividends for extended periods of time and shown a proven track record of financial strength. And that's the big ticket. You want to pay attention to the financial strength of a company. You want to be familiar with a company. Warren Buffett always says, don't invest in something that you don't understand. Don't invest in a company that you don't understand how they make money. If you cannot figure out how that company particularly makes money, don't invest in them. Right? That's the safest, surest bet. That's why he owns shares in Coca-Cola, because it's a very streamlined process for him to understand how Coca-Cola makes money. And so that's a really strong golden rule that I want to pass on to you as you embark on your investing journey. In previous episodes, I mentioned different opportunities and different applications that you can download on your smartphone to help you start off in your investing track and for further expanding your knowledge outside of my podcast. And so go back, check out those episodes, and take a look, and you'll be pleasantly surprised. They're not expensive, and they're not the traditional financial advisor. They're not the traditional means by any means. And so it'll help you get your foot in the door and really start honing those skills as you practice on your investment journey. The next things we're going to talk about is bonds. Bonds are debts. Bonds are companies or financial institutions or even state legislators. Different states offer bonds to buy into the community so they can there it is debt. They put out these bond funds that you can buy so that the company can use that money to do improvements to the organization, grow their marketing, grow the building, bring on new staff members. These are loans that you are lending your money to this company. In return, you get a guaranteed interest rate for an extended period of time, and whatever the time period that is. There are short-term bonds and there are long-term bonds, right? And so, depending on what you want to do with your portfolio and how you want to diversify that portfolio, you can have a mixture. You can. That's why people always talk about diversification. Diversification. You want to have a combination of stocks, which are, depending on the stock, can be a little bit riskier, and then maybe some bonds to balance your portfolio out, because you're basically lending money to these corporations and getting a guaranteed interest rates. Now, so the pros and cons is you're not going to get as high, you may not get as high as a return that you would get had you invested in stocks or any other type of investment. But sometimes you just want to hedge, or you want to kind of, what's the best way to put it? You want to kind of flatten out your risk portfolio, and you don't necessarily want to deal with, if you're the type of investor that wants to be very safe with his money, you don't want to risk a lot of your money, then most people are primed to invest more in securities and bonds that are safer. But without with that security comes the lower ending rate of returns. Typically, you'll see bond funds give a guaranteed rate of return of about 3%. And so that's big, right? So you have stocks, which are, depending on the stock portfolio that you choose, it can be of a higher risk, but with that risk comes a higher earning potential, or what we talked about, um, dividend payment. So those two things in stock investing are key, and those two things are something to pay attention to when diving into this investment um, a world and adding that to your financial portfolio. The next and third thing is real estate investing. Real estate is a unique endeavor, and it can provide some incredible returns for you. The tax code is actually encourages people to own their own real estate. That's why you hear so many people who own homes get massive amounts of tax breaks and tax write-offs and tax incentives for owning real estate. That's why you've always heard, these gurus that you see coming on these web pages talking about how I made, six figures buying rental real estate, or how I made this much money on fix and flip, because there's tax incentives with the right counsel and with the right people in your corner advising you and talking to you and educating you. There's a lot of money to be made, and a lot of tax breaks that can be taken advantage of. There are different types of real estate. There's residential, there's commercial, and even farm and land that you can own that can produce a income for you over the long term and into the foreseeable future. Residential real estate is any real estate that is used for housing. So residential is typically your apartment complexes, your single family homes, that your traditional two, three, four bedroom home that you would typically put a family in. And so any home that houses people, family members, couples, is classified as residential. Commercial is what you see in shopping plazas, shopping centers, shopping malls, shopping strips, shopping centers. Those are commercial real estate. Skyscrapers, buildings, major skyscrapers and buildings are also commercial real estate. New York, downtown Manhattan is filled with commercial real estate because those are typically utilized for business and business venues. So Trump Tower, that is a commercial property. That's a commercial building because not only is it used for housing, but it's also used for business. It's mixed use, is what the term typically is used for. But that's typically commercial. Your shopping centers, because those are longer term tenants, and those are typically people looking to lease those spaces to conduct some sort of business. And then lastly, farmland, right? You can actually buy land, and if you're in a very high agriculture area where there's a natural affinity for the economy in that area, to progress into looking for more land and expanding for more land so they can grow their crop shares. Um, if you take a major community and they're a major producer in cotton, then if you own the land and this company who wants to grow their cotton fields, their plantation fields further, and you own a portion of the land that they seek, they could actually pay you to rent their land for the utilization of the soil. And so that's a lot of people don't really think of that when they think of owning land or even farmland. Because if I need your soil, if I'm in an area and that's very barren and very dry, and the soil is very hard to maintain, and you're the only owner of, quality soil that I can actually grow my product on, then people are willing to pay you for that. The same thing with that. If a lot of times what investors are doing is they're going down to the city courthouse and they're looking at the city's projections and the Chamber of Commerce looking at the city's projections to see how that area is going to develop. What is that community's plan for development? Do they plan to build any major highways? Do they plan to open a theme park, a shopping center, a commercial building? And so what these investors will do, for example, when Amazon was looking for a place to move its corporate headquarters. Resident landowners were trying to predict where Amazon was going to build that headquarters at. And so if you own a piece of land that is ideal for Amazon's new corporate headquarters, they're willing to pay you for it. And they will pay you for it so that they can build their factory. They can rent it from you, or lease it from you, or they can buy you flat out because of the value and how much they need that property, that land. And so don't ever count yourself out from land ownership because it is a valuable asset and it does can if you do your research and you do your studies in advance, it can be very lucrative for you in the future. The fourth thing I'm going to talk about is real estate investment trusts, REITs. These are shares in trust funds or trusts or companies that operate as a business, and what they do is they particularly branch off into a specific sector of real estate. So this is different from owning real estate, what I mentioned earlier, because what I was referring to is the physical property, the physical building of owning that real estate. And so now what I'm talking about is an investment trust where a multitude of real estate is owned under the umbrella or under the the corporate sheltering of this real estate investment trust. And so there are different types of real estate investment trusts. There are real estate investment trusts that focus on commercial real estate in DC. There are real estate investment trusts that focus on the real estate in San Diego, California. That's a very big market. There are real estate investment trusts that focus on residential real estate in Florida. There are various things about real estate investment trusts, but the key thing I want to point out to you is real estate investment trusts can be a lucrative investment depending on the real estate market. Number one, because again, we're dealing with tangible assets, and two, real estate investment trusts have to guarantee a high dividend payment because um, of how they're structured. And so typically you'll see real estate investment trusts have to practically promise to pay practically almost 70% of their revenues has to go out in payments. It's not, they can't just sit there and just take your money and not pay you anything for that. So that's a unique too. I've seen real estate investment trusts that pay even in excess of 17, 14%. And so moving right along, that's I wanted to touch on, like I said, those key points with real estate investment trusts is that they are required to pay out high dividends to their investors, their stockholders, their REIT holders, because most of their money is supposed to go back to paying you. So a lot of REITs, depending on what type of real estate they invest in, you want to pay attention on what markets they invest in. Again, they can be as specific as the classification, whether it be residential, commercial, farmland, whatever. And they can be as geographic as they only invest in real estate in California or Texas or India or China or whatever the case may be. So do your research on that real estate investment trust and do your research on that asset class so you have a fair understanding of how that real estate makes money and generates revenue. Okay. The fifth thing I want to talk about is actually starting your own business. I can't harp on this enough. In a previous episode, I gave some key points on some things that you should pay attention to when starting your own business, and some real nitbits that a lot of people miss that lead to failure of a successful startup. And so, starting your own business can be the most out of all these things on this list. I personally feel starting your own business can be the most advantageous thing you can do for yourself and your family. That side hustle that you've been doing and producing revenue for on the side, consider it. Take a look at it. Maybe it can be a lucrative business. Maybe it can be that niche, that thing that allows you to leave your 9 to 5, allows you to quit um, working that job that you don't particularly care for, or instead of working 3, 4, 5 jobs with a lucrative side hustle, you may be able to let or two of those jobs go because your business is producing the type of revenue you need. And so check it out, consider it, and then go back and check out that previous episode about starting your own business in 2020. Okay, and last but not least, um, the last is patents and trademarks. Companies, if you have an idea, you have a product that no one else has thought about, you want to patent that idea. You want to get that idea legally protected because, and then you want to be able to um, offer your product in exchange for money, right? For money, for royalty payments, right? And so if you're a creative, if you're someone who has a mind for just ever changing ideas and new and complex ideas you can kind of put together in your mind's mind, get it patented, get it secured and get it legally protected so that, and then offer it to the world and secure that financial future for your family. And then trademarks, if you have, you know, Slinky was a $3 billion patent. Can you imagine? The Slinky toy was a $3 billion patent. So that family earned $3 billion over the course of Slinky's lifetime, and it's still today. You still see variations of it, but the first person that thought about it was able to secure $3 billion. Another idea was the Furby. Furby earns about $5 million a year off of the Furby brand and the Furby logo and the Furby idea. That was patented. That was protected. And so the other thing is, again, is trademarks. Trademarks are slogans or logos or um, different things that you can that you thought of or you want to protect that make that have um, has never been used or anywhere else. And so, prime example of a trademark is Akuna Matata is as you know from The Lion King. That is trademarked by Disney, and so no one can use that phrase in their logo or their slogan or their you know catchphrase without paying Disney for the use of that trademark of that slogan. So you have to pay Disney in order to use Hakuna Matata in your brand, in your logo, in your commercial. Disney has now secured that trademark. And so, podcast listeners, I hope this episode was really creative. I hope it helped you in some way, shape, or form Remember, gentlemen, stay tuned, stay focused, stay in the game. I know this is a tough time, but we will get through this. Once again, this is Marcus Noman, Gentleman Style Podcast. Take care of your families, take care of your homes, and take care of business. This is Marcus Noman, Gentleman Style Podcast, signing off. Bye.